Welcome back. It's now 12:05 Eastern. We are going to resume the program here shortly. The breakout room is still in session and may continue on for those who wish to stay there. Right now we're going to go for the Ship Finance Forum. Which way does the current flow? And I'm going to turn it over to Clay Maitland.
Our next panel, ladies and gentlemen, is completely consisted of people who I am very fond of because I get into ship finance a lot in my line of work. This is on ship finance, and it is entitled, Which Way Does the Current Flow? It is moderated by Larry Rutkowski, who I knew when I was younger, and he was very young, and we have remained good friends, amazingly. He is senior counsel at the law firm of Seward and Kissel. Joining him is Michael Kirk, who is managing director of RMK, which, by the way, are his initials, Maritime. And he is a highly respected commentator on matters having to do with money, always very important to the shipping industry. Martin Lunder, another good friend, who is managing director of Nordea, the biggest shipping bank and one of the biggest banks in the Scandinavian world. Michael Parker, chairman of Global Shipping, Logistics, and Offshore of Citi. I'm old-fashioned. I still call it Citibank. It's Citi. Christopher Rex, who is head of innovation and research for Danish Ship Finance, which is actually a company. And these very experienced people are going to answer questions from our moderator and also from you. Take it away, Larry.
Good morning. My name is Larry Rutkowski. I'm with the law firm of Seward and Kissel in New York. Like those before me and the rest of this panel, we welcome you to our presentation today. I'm going to be the moderator for the panel, Ship Finance, Which Way Does the Current Flow? As always, as Clay has mentioned, this conference has been able to assemble a wonderfully talented and knowledgeable group for our panel today. I'll only briefly introduce them since you've already heard about their backgrounds and where they work, but without trying to be too redundant and in the order they appear on the conference program, I'd like to introduce you to Michael Kirk, Managing Director of RMK Maritime, a well-known boutique investment banking firm servicing the maritime industry. Martin Lunder, who, as you've heard, is the Managing Director of Nordea Bank, one of the world's most prominent shipping banks. Michael Parker, Chairman of the Global Shipping and Logistics Group at Citibank, and known well to all of you here. And Christopher Rex, who's head of innovation and research at Danish Ship Finance. You may not know him as well as some of the others because he's not a ship lender himself, but he's got a very important position at Danish Ship Finance. My hope is that we will have a warm, spirited discussion on the topic of ship finance today. Our plan, as you probably heard, is to have a little bit of give and take amongst ourselves and between the panel members for about 25 minutes, reserving time for Q&A at the end of our time slot. So as you listen to these gentlemen who are about to speak, I would ask you to make notes, get ready to put your questions in the chat box or however the conference organizers have said to do it to you, and so we can be ready when the panel is over. I'd like to start off by quoting from Ben Nolan, a shipping analyst at Stifel, who recently said, perhaps with his eyes on only one segment of shipping, he said shipping investments should be made counter-cyclically, and longer term, we do believe now is a good entry point. However, the market could be stuck in a no man's land for at least 6 months, in our view, before there is a line of sight on an eventual recovery. The second part of those remarks sound like something you might hear from Dr. Fauci at a press conference, but I would like to explore the thought a bit with the panel before we drill down into specifics. And Christopher, I'd like to start with you. You and your institution, Danish Ship Finance, publish a well-regarded shipping market report every year, and I found your November 2020 report particularly interesting. Though we're mired in a pandemic, and it was certainly mentioned by your report did not lead with the pandemic and was focused on environmentally driven topics. Let me, if you will, quote briefly from the report. One remark that really jumped off the page to me is where the report says, traditionally, ship owners have been the cornerstone of the shipping industry. They've built the right vessels at the right time, at the right place. They have enabled the global trade expansion throughout past decades. It was a model that worked well, and when Carrier's emphasis was on expansion. But times and market dynamics are changing. The global call to reduce CO2 emissions is raising costs while leaving revenues vulnerable to overcapacity. Today's market trends highlight the urgent need for change. Could I ask you to expound upon that a bit?
Sure. Thank you very much. First of all, when we all look into the crystal ball and try to imagine how the future could look like, we can easily see that the climate agenda is top of everybody's minds these days. So far, the climate agenda equals higher costs, either in terms of investments in new fuel types, pilot projects, or investments in new technologies we can install on board the vessels in order to try to optimize operation of these vessels better. But we have seen very little to support the revenue side, and we are still seeing that the global freight markets are super volatile and cyclical. And to my understanding, we are still looking into even though the medium to long term these days looks better, and we begin to see some hopes and dreams of higher freight rates and better second-hand values, we are still seeing a freight market that finds it difficult to yield a return on invested capital. So I would argue that for us to understand what needs to be done, in order to decarbonize, we need to look very much into our business model and identify a potential business model innovation that can actually create more value instead of just adding more costs to the equation. That's what I'm seeing in the short to near term on the climate agenda and digitalization push.
On mute, Larry.
Yeah. What does this mean for financing vessels? Does it mean, in your view, in DSF's view, that the market is going to be just getting tighter and tighter for finance because as the cost pressures, upside pressure on cost, the downside pressure on revenue, particularly during a pandemic, is it going to make it impossible for anyone to raise enough capital for further expansion, or for that matter, retrofitting of the vessels that they do have?
I don't think it's impossible, but I think that in particular when we look into the new investment required to lower emissions of existing vessels, I think that we will need to see more equity put into the equation. Many of these projects are super high risk, and that is demanding more equity and are less obvious for debt, but I'm sure that some of the senior bankers can expand more on that on a later note. But clearly speaking, I think it's difficult to see a clear pathway to zero carbon shipping at this point in time, simply because cost structures are rising and revenues are not following suit. So it's difficult to see the obvious balance in many future investments, at least at this point in time. We need higher freight rates or a better balance between supply and demand, or more equity.
Thank you. I'm sure that's a theme we're going to come back to frequently this morning. Michael Parker, I'd like to turn to you and following up on what Christopher had to say. If my recollection is correct, you spoke at last year's conference about the Poseidon Principles. In fact, I think I may have asked you cynically whether the bank's endorsement of the Poseidon Principles was just an attempt to make good press with their regulators and their shareholders while shifting the cost burden to already struggling ship owners. You had a rebuttal for that argument, which was quite direct, so I won't repeat it here, although you're welcome to address it again. We're now a year out or more from the adoption of the Poseidon principles. You've seen it in action. You've been very involved from the start with the entire project. So can you tell me a little bit about what those principles have done to shipping, whether it's worked, how it's changed banking, and whether or not your clients have adapted?
I will answer that question, but let me just comment on what Rex just said, because I puts it in context. Shipping has always needed a better balance of supply and demand and more equity. And what it is experiencing now is a sort of deleveraging. But to Chris's point, ultimately, revenues have to drive the shipping industry in order to generate the cash flow to pay back the banks and also to get a return on equity. And the challenge of that, of course, is going to be in the cost of new technology, new fuels and everything else. I think now to answer the very specific question, we reported at the end, mid-December, and Martin Nordea is a signatory to the principles. We all reported our alignment to the IMO's global fleet trajectory, and we were 15 reporting. It was 14 original signatories plus one who joined later. And we're going to be shortly announcing we're up to 23 signatures, I think, and probably representing nearer 50% of the total debt outstanding to the industry. So despite COVID, we continue to add additional signatories. But one of the things that publishing this first report has forced us all to do, and ship owners, is for ship owners to implement the DCS regulation, providing data to the IMO through flag state verified by classification societies on their fuel consumption and other things that make up the AER calculation. So that was a first for them. And so the first year of the Poseidon Principles was using that data, getting that data, which is confidential to the ship owner, to us in order to make our portfolio alignment. That was the point, if you like, when we reported on the 16th of December, where there's no turning back for the existing signatories. What we're reporting is a percentage alignment or misalignment. And it's really from what happens from now on in. And I think we have to put that in the context of what's happening globally. So what, for many of us, Martin and I have been around a long time, we can remember how sort of shipping finance sort of worked to its own rationale, regardless of what was going on in the rest of the world. And I think what's now changing is as the whole world goes into the whole industrial economy, including China, including more controlled economies, goes into this transition phase with the goal of net zero at some point, including China. So all investment is going to be dictated by this agenda. And the transition will, I think, be accelerated from what it would be before, because both governments realize the importance of it in the absolute sense of climate change and the damage to the environment, but also all the other regulators. So the TCFD work, we're beginning to see, all banks in the world governed by Western regulators will be adopting TCFD, will make some sort of commitment to their portfolios. And in a way, what we've done in shipping through the Poseidon Principles is lead by example. And if you talk to many of the NGOs looking at this leading up to the climate change conference, if other industries can take the approach we have in shipping and find a way of measuring their emissions, then it will motivate charterers, it'll motivate finance. The Sea Cargo Charter, which was launched last year at the Global Maritime Forum, but took effect this year, that is charterers, that's the cargo owners saying we want to be held accountable for the emissions. So they're holding owners accountable for their emissions. So you can see that this becomes something across the whole maritime ecosystem, and the insurance sector is now looking at the same thing. So I think where that ends up is that the data we have, mainly now obviously emissions data, will influence our decisions. What we've stressed individually as signatories is our lending policies are entirely up to us individually. There's absolutely no collaboration or coordination other than we do in a market sense around syndicated transactions. So it's up to each signatory to decide how they will implement those policies. And we will be guided, and this is where environmental factors become a very measurable item, where before it was a more qualitative judgment, by publishing our alignment, and also in the context of the fourth greenhouse gas study, and therefore broader macro judgments on emissions of the global fleet, how we as the leading banks are using something like Poseidon Principles to positively influence shipbuilding and the new technologies, we will be measured. So what I'd say is we've learned a few things, that we won't change the underlying principles until maybe the IMO changes regulations, and so they'll evolve in the light of that. But I do think our decisions in each of the signatories are now very much going to be influenced about how we interpret those results in the context of our own portfolio. And what I would stress is that we're all learning, including the IMO, we're learning that emissions are just as much about operations as they are about design of the ship. And there are reasons why certain ships may, in one year, have a higher AER than the other year, even though it's the same ship. We've also seen differences on the same type of ship with different operators. So we're learning a lot. And I think what we'll see, particularly this year, and increasingly, is this use of data, not just for investors. And we see, Larry Fink's letter last week, is an illustration of investors looking at environmental factors, KSIs and stuff, but there'll be more and more data which is hopefully transparent that we can then judge things by. So yes, I think our decisions are already being influenced. They were being influenced by the broader thrust, and some banks in Europe, the Scandinavian banks, the French and the Dutch banks in particular, for national reasons, already far down this road. But I just want to sort of finish this comment on last Friday, Gillian Tett of the FT, the editor of the FT in North America, wrote the leading article with the headline, "Olive is the new green in fighting climate change." And it's a very good article, and it speaks exactly to what we've been talking about in shipping, which is it's all about lowering emissions. So in parallel to investing in the new technologies that will lead to zero emission vessels, we need to be doing everything today to lower emissions through retrofitting, through new technologies, through how ships are operated. And that is how the shipping industry will be measured en route to that zero emission. And that's how we as lenders, I think, will be using, if you like, the so-called carrot and stick that Hugo de Stoop referred to in our drafting sessions. We'll be encouraging owners and helping finance that retrofitting. What we know is that the existing fleet is better retrofitted to lower its emissions than the emissions of building new ships with old technology that the global fleet doesn't need. And whereas most banks have used age as a sort of cutoff point, we can now actually use much better data where age is less relevant, other than surveys and stuff clearly. We can actually use better operational data to justify lending on an older ship. And that's going to be reinforced by the charterers. Cargill have been very clear they will charter older ships that meet their environmental metrics. So I think we collectively, the ship lenders, have led other sectors, and we're very conscious of the commitments we've entered into. But the last thing I will just say is, if our scores change from year to year, it shouldn't be interpreted that we made bad decisions, because we're still living with the decisions in our portfolios we made some time ago. But it's the new transactions we do, those are the ones that will show up in the alignment results over the next few years. That's really what we need to be judged by.
Thank you, Michael. Martin, I'd like to turn to you. Michael's given us a very good global picture and told us a lot about how these principles are intended to operate. what can you tell us about the impact it's had on Nordea, how Nordea does business? And I don't mean to throw a curveball into this, but since we are a panel about ship finance, not just environmental regulation, has your portfolio, has it changed? Does it look different following the implementation of the Poseidon principles? I would just remind you to go off mute now. Martin Lunder?
There we go. Yes, I thank you for that reminder. Of course, I needed that. So thank you, Larry. At first, I kind of want to echo, what Michael and Rex have said, and particularly Michael. He puts it into perspective what we're going through, and I think in my simple words, I think two things come to mind. Number one, it's a journey. We have started a journey towards a better future, and we're just at the beginning of that journey. And I think we all have to understand that it's not going to be perfect now, but we are working towards a better goal. And the second one is it takes a village. Nobody on their own can achieve these goals unless we all contribute and work together. And I do think banks, through the Poseidon principles, have taken a leap forward and trying to set an example and trying to impact the outcome here of carbon emissions. And but the point is, I think we try, but we can't do it alone. And therefore, hopefully, our example will be followed by other industries. I can say sort of just as a big picture step back that a reflection from last year, I think, people probably know and you can see, but Nordea is more committed to contributing to a sustainable society than ever before. And I see this every day in emails and statements from our senior management. We clearly, and this brings about this thought that when Michael said, we have seen so much from over many years, it clearly, when you get this information in, you start automatically also thinking about ESG commitments on your clients. Although it's not part of the credit policy per se, it's something that's a factor that is talked about and discussed, and something we certainly we consider. And I think that the Poseidon principles is interesting because it makes us collect data, and it was the first time, and then next time we will be able to see trajectory on individual clients and their progress towards their goals. And even if it's not necessarily a hard requirement, it clearly will help us and force us to actually take a look at that and say and give some opinion of that client's journey toward their sustainability goals. And I won't come as far as saying that that people that don't move forward are going to be penalized, but I do think that companies that move forward on a positive trajectory will see benefits. And I think that's, again, as I said, it's a journey, and we have to start small and get people to move in the same direction. And once we get it going, I think we will move faster and faster down this path. We have seen an interesting development if I go more granular into our financings. We have seen, financings that now introduce sustainability-linked targets. So, for example, on the bank lending side, we see transactions where targets are defined by the client. They have a strategy. They have set certain key performance indicators. These are validated by external media or external institutions. And then, if you meet the target, you get a reward in terms of lower margins. Now, it may not be very large movement, but it's an indication of what's to come. On the bonds, we have seen somewhat a different approach, but still what we see is a sustainability-linked bond. And let me just pause. There's a difference between sustainability-linked and green. Green, the proceeds have to be used for a qualified purpose. Sustainability-linked is more about meeting your sustainability targets that don't need to be themselves have to be approved. It's rather they have to be agreed, but then you have to meet them. But again, so going back to the bonds, what we've seen are sustainability-linked bonds, and they have different hurdles. But the interesting part is that suddenly the universe of investors are bigger for those bonds than the bonds that don't have sustainability link. And that in itself actually provides better dynamics for the bonds, more liquidity in the bonds, more investors looking to invest. And we all know what that actually means. We have not seen the same thing on the lending side, because yet that, we suddenly get a lot more banks interested in sustainability-linked loans. But I do think that over time, sustainability-linked loans will get a preference versus non-sustainability-linked loans.
Thank you. That's an interesting observation. I don't know if we'll have time to get back to that, but we've already heard a couple of remarks about the need for more equity in shipping if there's not going to be finance. And aside from those people who are fortunate enough to have gone long on GameStop last week, I'm not sure where the equity might come from. Mike Kirk, let me turn to you. You and I have had some interesting times together this year. I don't think in transactions that we worked on we thought much about the Poseidon principles. So I'd like to take us out of the bank realm and out of the realm of the big ship owner who has access to the likes of Nordea and Citibank, or maybe even the capital markets. What's going on? Where are people getting money? I think I've heard that you folks are starting up a direct lending alternative. Others have tried that. You can tell me how you perceive their levels of success. But I'd like to hear from you on this subject, because it's sort of like talking about everybody else, right? You've got a big burden today.
Sure, thanks. Yeah, so I think, listening to the other panelists, I think certainly that's where we're going. That's the future. But there are a lot of ships on the water today, and a lot of those ships need to be financed. As we look at it, we launched a platform called Ascension Finance, and Ascension is basically set up to take advantage of those situations. We kind of look at it to modify the words in the Statue of Liberty. We're looking, give me your non-corporates, give me your aged vessels, give me your not perfectly green ships. And that's what we're lending to keep that market going, as these new ships come in and, clean up the industry a little bit.
That's an interesting and important observation, because based on what, Christopher, Michael, and Martin have all said or implied, capital on the lending side, bank lending side, is still going to be a little bit dear because of the rising cost, and we still are in this pandemic mode, and maybe we will be out of it, and we'll see more favorable market circumstances in 6 months or more. But if I have an older non-eco ship and want to get a loan, who do I go to? Because I don't have that much equity to put in, and certainly not enough equity to retrofit perhaps my small fleet. What do you think, Mike?
Yeah, no, I think there's a lot of lenders that are coming out specifically for those situations. I think the debt markets for shipping, are going to be a lot better, I think for the next decade, certainly for the next 5 years. I think there was a lot of pain, over the last decade. It didn't really make sense to be a ship owner in the early 2000s because, you were getting small returns while equity, made money hand over fist. The last decade, you had a lot of lenders lose money as values fell. Now I think we're in a much more stable situation. The order book's in a much more manageable place. Because of some of the new regulations, we're not seeing people go out and make orders, because people want to know that, hey, if I order a ship, I want my engine to last not just for the next 5 or 10 years, but for the next couple decades, because these are 20, 30-year useful life assets. So because of that, and because values, right now cash flow yields on ships are as good as they've been in a while, and we don't have a big order book. So right now as a lender, you can feel confident in cash flows coming in. So I think it's going to be a good decade for whether it's an alternative lender or or the traditional senior lenders lending on some of these new ships. But we should be in a stable cash flow market, which I think is going to be good, and ultimately that's going to bring back the equity. But I think we have a little time on that.
Good. That's a good observation. I do want to ask you a follow-up question. A lot of the alternative lenders have, in my view, they charge a fair amount of money. Pretty high coupon on their investment. How many people? You can't quantify it really, but does that coupon and the tough market circumstances we have just put some people completely out of the finance market, or can they solve their problem perhaps with a little bit of an equity link type investment?
Yeah, but there's all kinds of ways to get there. I think it's really difficult to lend, high LTV with a high cash coupon and amortization, because ultimately, these are commodity assets that can only support, a certain cost of debt. And so I think it's, if you're going high LTV, you may want to put something in there where you're giving away some upside if things go well, but you're protecting those cash flows in kind of a normalized or certainly in a down market. And so we see structures across the board, and there's any number of structures from a lot of equity upside given away, but maybe lower debt to, again, sky high debt costs that are hard to manage unless things go really well, and then someone's taken a real bet on kind of asset value appreciation. So when we look at things at Ascension, we try to look at loans that in any market are going to be sustainable, both from a yield and amortization perspective. And again, I think given where we are in most markets right now, asset values are kind of in their bottom quartiles, with maybe the exception of the container market. And so you feel comfortable about lending, in this market.
Great. Thank you all very much. We're pretty much out of time, except for a limited Q&A session, and I do want our audience to have a chance to ask some questions. If not, I will probably come back to you in the very, very near future. And I'd like to ask a little bit more about this sustainability drive, whether 2050 is reasonable. I'm sure Michael Parker will have some things to say on that. It's not just shipping. I read a headline this morning in the New York press, financial press, about I think it was GM, has announced that they're going to phase out gas-powered vehicles by 2035. That doesn't have a direct impact on me, because I'll probably end up having, if I'm around that long, I'll need to buy a new car anyway. So can adapt. But when you have longer assets like ships, as Mike Kirk observed, it's a different world. So thank you all for now, and we'll be back together real soon. Thank you.
Okay, before we go into the live Q&A for the Ship Finance panel, just a program note. If you were in the breakout room at the beginning of this Ship Finance panel playback, it will be archived up in 24 to 48 hours if you missed any of it. And if you did, it's worth seeing. So I'm going to turn it now over to Larry Rutkowski for the Q&A. Larry?
Thank you, Dave. Thanks very much to the panelists. That was a great discussion. Those of you who missed, I suggest you do catch it when it's archived. I'd like to turn back briefly to something that came through, perhaps in an obvious fashion, perhaps a little bit more subtly from some of the remarks that were made by our bankers at the table when we talked about the increasing cost that retrofitting and getting to zero emissions decarbonization imposes on a ship order. There was Martin's talk of we're in a village, we're in it together. Michael Parker talked about cargo owners focusing on this. The suggestion, the hint, the principle behind that is that charterers will pay for these retrofitted vessels. Am I misstating that, or do you all agree?
Well, some of them have said it publicly, Larry. Cargill has come out and said very publicly they will. And I think if you talk to some of the oil majors, you know, they would say the same thing. But you know, I think one of the reasons for this is building new ships with old technology makes no sense from a global emissions perspective. And therefore, there's no point in scrapping quality ships that with some investment can actually have a prolonged life. We know as banks that we want the reassurance of some sort of locked-in cash flow to finance that. And so I think there will be a lot of, you know, smaller loans. For us as Poseidon Principal signatories, it's about lowering the emissions in our portfolio. And if we have existing ships in our portfolio that need refinancing, if we can help those ships to stay in operation and lower their emissions, then I think we're fulfilling our obligations.
Yeah, I for one didn't mean to sound incredulous about that proposition, but I find it such a radical change from where we were just a few years ago. My memory is that it was in just a couple of conferences ago that the argument or the debate, perhaps, was whether or not it was worth an owner having an eco ship built versus having an older technology ship built, because they weren't getting any benefit from the market. No two-tier market developed, and yet in a short time, it appears attitudes are changing. Would anyone like to comment on that development? Martin?
Well, I think that it goes back to, I mean, it is a demand-supply question. And I think, you know, hopefully over time, charters will pay up for you know, compliant tonnage, and maybe through shareholder activism and looking at, you know, what we see today, that there will be a movement to do that. But still, I think we come back to demand and supply, and that will be the fundamental drivers in the market on rates. So we have to watch this carefully, and we as banks, you know, we have to tread carefully, because at the end of the day, the cash flow pays us back, and we have to make sure that cash flow is there, and that has many factors that come into that input, but including, you know, trajectory towards a more compliant future.
Christopher, I don't want to put you on the spot, but I will. As I mentioned at the outset, your market report, DSF's market report, talked a lot about these environmental factors and talked about the additional cost burden on the owners. I didn't necessarily detect a whole lot of optimism in that market report about freight rates matching these increased costs. Could you comment on that?
Yeah, sure. First of all, it would be fantastic if we can persuade anybody else to pay for the additional cost, whether that is cargo owners or whoever. I mean, if we can find a level playing field with regulators telling us that everybody needs to comply, that will clearly be the most obvious way going forward, or with a carbon tax or anything like that. But I think one of the hypotheses in the report we presented was that if we could actually begin to see super scaling of the production of zero carbon fuels to a degree that would allow real price cuts, cost cuts in the production of, let's say, green ammonia, that would be super interesting. This cannot necessarily happen overnight, and this cannot happen for all players in the industry, but that was why we talked a lot about sector integration and first movers going together and securing large offtake channels, large offtake volumes of, for example, green ammonia for a specific price, even on an index-linked discount, maybe to the tune of 30 or 40%. That's what we have seen in some of the pilot projects lately. So I would also hope that we could see the green fuels becoming more cost efficient due to scaling, rather than because somebody else would like to pay more for a more green service. But presumably the reality will be a combination of the two.
Thank you. Mike Kirk, you were very optimistic to conclude the panel about the availability of ship finance in the near and intermediate term. Is that optimism tracked or parallel with respect to your views on the freight market?
Yeah, I think that's kind of why I've got some optimism. I think right now, capital is still a little bit difficult to achieve, whether debt or equity. I mean, if you look at the energy sector right now, it represents less than 2.5% of the S&P 500. You go back 10 years ago, February 2011, it represented 12.5%. 10 years on, is it going to be back at 12.5%? Maybe not. Will it be higher than 2.3%? I think almost certainly. So it's out of favor, and it's kind of got to figure itself out. And I think the shipping market, obviously transports a lot of that energy and kind of falls victim to, some of the sort of investor appetites, et cetera, that impact the energy sector. So I think cash flow, positive cash flow, which I think we're going to see over the next, 3, 4, 5 years, will really help bring back investment in the sector. So I think initially these investments need to be structured, maybe need to be a little bit unique, but investors will do well, and then you're going to see more regular way investing in the space.
Oh, I see. We have one question from the audience. Can I ask the panel's opinion on carbon offsetting? Can this be compared to a ship owner improving the efficiency of his or her ships? That's from Alex Dogger. Anyone want to take that one?
Shipping doesn't need offsets. The aviation industry has put a lot of focus on it because they don't yet have the same sort of technical solutions. Shipping does not need it. Now, it doesn't mean shipping and cargo owners can't use it, but it shouldn't be seen as a solution. It should just be something that, and I think a lot of the greenwashing of offsets is being addressed now. The initiatives from Mark Carney and Bill Winters around some of this stuff, I think, is very important. So it's not a solution. It could be a temporary solution if you can't lower your emissions somewhere. So not really relevant to the shipping industry.
So you're optimistic, Michael, that we're going to get to zero carbon by 2050?
Well, I am. I don't think I'll be around to see it. But the point, I suppose, is that what the pandemic has shown us is that when the world puts its mind to do something, and the science and technology is there, it will happen. And I think the force of the capital markets, investors, governments, regulators, I think we're going to see some very surprising things begin to happen in terms of collaboration in the next few years. And I think we will be, it's very different, and we will be surprised. The other thing I think is the importance of the shipping industry to every other industry in moving their cargoes around the world means that everyone benefits from the decarbonization of shipping.
Thank you, Alex. I hope that answers your question. Given the time, I'd like to end on that optimistic note. I know we could talk about a number of these subjects forever, but I don't think our conference organizers would sanction that. So I'd like to again thank the members of this panel. It's been a pleasure. I look forward to seeing all of you very, very soon. Thank you. Back to you, Dave.
Thank you, Larry. We're going to go to a commercial real quick, and then we'll have the intro from Clay for the next panel, digitization in shipping and logistics industry.